CNBC TV 18, celebrating 15 years of leadership.
Hello and welcome to Markets. Today I'm Lata Venkatesh here in Mumbai, and with me is Surabhi Upadhyay in the Delhi studio. Surabhi, it was a very choppy day, but the important point was, despite some deep cuts in the Asian markets, our markets, after starting gap down, actually managed to end flat. That may be only a temporary consolation though. Hi.
Absolutely, Lata. So start of the week on a very, very cautious note. Let's actually run through the headlines first up. Markets start the week on a lackluster note of trade as global growth concerns persist. The Nifty is down just 5 points after a pretty choppy session. Bank stocks hold up, but IT and oil and gas remain weak. TCS hits a 5-month low on management's cautious Q3 outlook.
Midcap index loses half a percentage point, falling more than blue chips. Spicejet plunges 5% as the management meets the dgca to chalk out a revival plan. However, mastek hits 20% upper circuit after its subsidiary Majesco announces merger with a US insurance software company, CoverAll.
The wholesale price index shows a 0% gain for November versus expectations of a 1.1% rise. Rate cut hopes keep bond prices and bank stocks perked up higher.
And here are the experts that we have lined up on the show for you tonight. Market perspective from Sanjeev Prasad of Kotak Institutional Equities. Deepan Mehta will join us to tell us what sectors and stocks he is watching out for. And we will also get you a whole host of experts to talk about the macro picture.
Okay, before we get to all that opinion, let's straight away go to the day's trading action. The first day of the week starting with a huge gap down opening, led lower by the IT pack. But then by close, the Nifty and the Sensex managed to pare most of those losses, supported by the financial space. For a more detailed wrap of the trading action today, let's go across to Anuj Singhal. Anuj?
Well, it was quite volatile, but it was on expected lines, really, the opening and the recovery, because the global cues were negative. It looked like the markets would open gap down, but because the market has been coming down so heavily over the last 5 or 6 days, the market had become oversold, and the market did come very close to hugely significant and hugely important support zone of 8150 to 8200, and that is where it bounced back from. And to be fair, the bounce back looked real in nature because it was being backed by the market leading sector, which is financials. Financials did remarkably well in trade today. Of course, IT was the pocket which was hurting the market. Let's talk about some of the stocks. In fact, HDFC alone accounted for 25 Nifty points in today's trade. That was the big contribution from HDFC, almost a Virat Kohli-like performance. Then you have HDFC Bank and Kotak Mahindra Bank as well, doing quite well in trade. Apart from that, of course, you had IT on the weaker side today, led by TCS and the call that it had on Friday, which made some investors nervous. So it was down 4%, and along with it, Tech Mahindra and HCL Tech were also down quite a bit. Some other prominent Nifty losers included a lot of commodity stocks. BPCL, that was down quite a bit. Apart from that, High Beta was down, so DLF was down 5%. Tata Motors was down about 1%, and metals were down in trade today. Metals, in fact, are in a confirmed bear market now. So stocks like Sesa, Jindal Steel, NMDC were all lower. In the mid-cap basket, the trading side wasn't feeling good about today's trade. Your stocks like GMR, Jet, Aban, all down between 6 to 7% in trade. And there were some stray winners in today's trade, but most of them were news backed. So Mastek was up 20%. You had Career Point that was up 20%, and JP Infra was up about 8%. So the sense you get is that today's second half rally was pullback was essentially short covering, and the market is not out of the woods yet. I'll be watching out for 8150 to 8200 zone. On the way up, 8300 becomes the first resistance.
Thanks a lot for that, Anuj. I take your point about this bad feeling that the market left you with, but just a word on the Bank Nifty. I would have expected some support and recovery to be spearheaded by this index simply because of the way in which inflation numbers have come in and the way in which bond prices have moved. Today, the bonds moved to a fresh, a 14-month low in terms of yields. We saw 7.78 being traded, and that's because the CPI number came in at 4.4%, and the wholesale price index inflation number came in at 0, the lowest level that we have seen since June of 2009. So clearly there was an expectation that the expected Reserve Bank cut would be advanced probably to January or February, and when it comes it could be a 50 basis cut. And that rise in bond prices had this propelling impact on stocks like HDFC, which borrow from the market, as well as stocks like Yes Bank and a whole host of NBFCs and smaller private sector banks, which are wholesale borrowers and which are quality stocks anyway. So that's where the support came from today. But it is still an open question whether this kind of support can last too long, especially if global slowdown cues continue to come thick and fast.
All right, so rate cut hopes floating high in the market. Let's get you some market opinion now. Sanjeev Prasad of Kotak Institutional Equities believes that the dip should be used as a buying opportunity. On the growth front, he expects to see the GDP at over 6% from FY16.
Any dip would be a buying opportunity, and if you look at India, a lot of value has started to emerge in some of the ignored names. Case in point is, for example, Reliance Industries. This is a forgotten stock, and it's not really performed as a rally, and when the market corrected, it's corrected more than what the market has corrected. Good quality names in autos and banks, which we really want to play the economic recovery, as also the decline in interest rates themes going forward. Valuations are still on the higher side, but I would think any correction over there is a buying opportunity. It's a fantastic growth story at the end of the day. Obviously, GDP growth will take some time to recover, but at the end of the day, if you look at 2016, we are still talking about 6% plus real GDP growth. Hopefully, as reforms scale up over the next 12-24 months, India could get back to about 7% plus GDP growth from fiscal 2017 with the implementation of GST and further reforms. Two themes which we have been talking about is recovery in GDP growth over a period of time and economic activity, and the second thing is lower interest rates. So clearly, the two sectors which we have been very overweight are auto and banking. We continue to have a large portion of the portfolio, 50% of the portfolio in the auto and banking names, which play very well on these two themes.
Okay, that's the long-term opinion. And now for, once again, the day's action in the futures and options space. Let's go across to Nigel D'Souza. Nigel.
Well, in the derivatives market in today's trading session, if you were writing options, you made money. So on the put side, the 8,200 put, let's see the premium crash from around 45 bucks all the way to around 40 rupees. You were writing that particular strike, you would make money then. And the 7,900 put as well, the premium over there fell from around 5 bucks to around 4 rupees. So clearly the downside of the market as well after that sharp correction of around 400 points appears limited. Looking at the call data as well, we did see writing at various strikes, but there was some unwinding at around that 8,450 call. So traders don't believe that the Nifty will get up and running towards that level, and now they're writing lower level calls. So the 8,400 call as well as the 8,300 call, there was writing being seen on both those two strikes. On the 8,300 call, the premium crashed from around 65 rupees all the way to around 51, 52 rupees. So writing was beneficial in the options market. Taking a look at individual stocks, TCS was getting sold into in today's trade, and Tech Mahindra as well, that has been the relative outperformer. That one as well did come in for selling pressure. DLF as well as BPCL, they have been getting shorted on a day-to-day basis, and today was no different. Both those two stocks did get sold into. On the flip side though, we saw some support coming in from the likes of Kotak Mahindra Bank. That one did see big buying in trade today. Coal India as well did see big buying in today's trading session, while on Yes Bank as well as on Havells, on both those two stocks, we did see a bit of a short covering bounce.
All right, Nigel, thank you so much for that. Let's move on to all the action that took place in specific stocks, and IT really was dominating the headlines today. TCS was the top loser on the Nifty, dragging the overall IT index lower by 1.5%. And then, of course, other IT stocks also followed suit, reacting to TCS's fall and, of course, the management's negative or slightly more cautious Q3 commentary. However, the one stock that bucked the trend was Mastek, which rose nearly 20% after the company's insurance arm, Majesco, announced plans to merge Coverall Technologies with itself. Rima Tendulkar has all the details of today's tech action. Rima.
Thanks so much for that. IT sector clearly in focus. TCS hit a 5-month low after the management sounded a cautious note in its analyst meet held on Friday. So they indicated that seasonality, cross-currency headwind as well as the negative sentiment will impact them. They expect cross-currencies headwinds of 220 bips in Q3, which will hurt their dollar revenue growth. But it's their commentary on the sentiment and the environment which have set the street, because the management indicated that momentum has slackened. The company was more optimistic at the beginning of the year compared to now. So this came in as a surprise to the street, which is why brokerages like Barclays lowered their target price by 4% to 2,900. They also said that this could impact the growth trajectory even in FY16. But most of the analysts believe in the long-term story of TCS, and therefore they see any weakness in the stock a buying opportunity, which is what Kotak had to recommend to its investors. But this weakness in TCS also dragged the other IT stocks lower. So if you see the charts of an HCL Tech, a Tech Mahindra, Infosys, all under pressure. Mastek in this stood out. It bucked the trend after the company announced its plans to merge with Coverall Technology. They're planning to merge the wholly owned subsidiary of its insurance business, Majesco US, with Coverall. Now, Coverall is listed on the NYSE. It has revenues of $20 million, margins of 17%, which is why this transaction will be EPS accretive. But this transaction requires that Majesco US will be listed on the NYSE, and this transaction is expected to close in the second quarter of 2015.
The entire transaction will be EPS accretive for the combined company. It is in our sweet spot, as I mentioned, in the PNC space. And what it does, it takes us to the $100 million mark, which is something that we wanted to meet the threshold. It also gives an opportunity for us to list on the NYSE and, in short, create a tremendous shareholder value for the Majesco shareholders in the US and for the Majesco India shareholders once we have the demerger panned out.
Okay, that's the Mastek story. Now for the stock that took a beating, SpiceJet shares. They took a battering in trade today, even as the airline's management met the aviation regulator, the DGCA, to discuss the company's payment plans. Sindhu Bhattacharya covered the story for us.
SpiceJet officials, Chief Operating Officer Sanjeev Kapoor, Mr. S.L. Narayanan and others met the DGCA and Civil Aviation Ministry officials today. The airline was expected to submit a concrete plan for payment today because the DGCA had given December 15th as a deadline before taking any further action on the airline last week. The DGCA has already barred the airline from taking bookings beyond 30 days, which has impacted SpiceJet's revenues. The airline is also believed to have been put on cash and carry by Indian Oil Corporation. Our sources tell us that some other oil companies have already stopped giving fuel to SpiceJet. The airline did not comment for this story, but unless a concrete plan, payment plan has been given to the DGCA, SpiceJet could face a bit of difficulty. Also, the Airport Authority of India may just be putting it on cash and carry also because of mounting dues.
Let's take a break on that note, but coming up, more market perspective, and we'll also get you some trading ideas.
CNBC TV 18, celebrating 15 years of leadership.